Okay, Sanjay, good morning.
Sanjay.
Hi. Last time you said 7,900 was the bottom. Stick your neck out. Can you say with same conviction that somewhere around here is the bottom, or has the bottom now moved a bit lower and something which we can't predict right now?
No, I don't think so. I constantly maintain that 7,900 is the bottom, and the second checkbox they had was on the rupee dollar, and that also has been achieved now, because I always thought that, and I always had in my hypothesis that we would see 65, 66 range in the currency. We've seen that now, and with even at 66, we are at 79.90, 79.50 kind of levels, and I don't see any reason why 7,900 would break really.
Okay. Hi, Sanjay. Thank you for joining us this afternoon. Would you deploy what, 10% of your cash, 30% of your cash? Because you think we are pretty close to the bottom.
I think I would deploy about 50% today, because I think the worst would play out by evening today in the Dow and as well as in the world indices across the board. I don't see the central bankers as well as policymakers worldwide, sleeping it off any more than what they have done over the weekend. And we would see some sort of action to, calm down the markets, whether it's some amount of job openings, some amount of action that will come in, because the recovery even in the U.S. is quite fragile at this point of time, and as well as the rest of the world. In fact, there is no growth, there is no recovery at all. So at this point of time, having the contagion to spread further, even into economies which are relatively better off, would make it worse for the world. So I don't see any reason why beyond, say, today or tomorrow, the policymakers worldwide would take up some concerted action to, stabilize the world markets.
Okay, by the way, the Nifty is back at 8,000 now, 8,002. So there's clearly been a bit of a recovery, and it will be interesting to see if this sustains or not. For now, the Nifty trading above 8,000. No recovery in the Bank Nifty though, Sanjay, and barring BOB, most of the PSU banks are back below those Indradhanush announcements. What's your call on some of these banking names, both private sector and PSU banks? Do you think that this is still a good time to buy some of these, or do you get a sense that leadership has firmly gone away from banks and they're not going to outperform even if the market recovers?
No, I think PSU definitely it's a good time to add into them. Private sector banks, I would still be worried. I would still be concerned because, the valuations are towards the higher side. We aren't too sure about, what kind of restructured assets, what kind of restructuring, what kind of, the want of a better word, maybe sounding harsh, evergreening that's already taken place within those books. At least that's the relief I have in PSU banks. Every 2 to 3 years, the PSU bank chairman changes, management changes. So therefore, whoever comes in, bites the bullet, cleans up the book, and, you're back in business again. And at least at this point of time, last 2 to 3 years, PSU bank chairman and PSU boards are extra cautious and extra conservative on provisioning and other sides. And more than that, Indradhanush should be one of them, but RBI, government, everyone is completely seized of the issue, and by the day looking at it and trying to tackle the NPA problem that is rising out of industry, arising out of various policy issues of the last few years. So that's what makes me a little optimistic on PSU banks compared to private sector banks.
Stay on for a bit, Sanjay. We also have another guest joining us, Sreesankar, the head institutional equities at Prabhudas Lilladher has also joined us. Good morning, Sreesankar. Thank you very much for joining in. What's your take? Would you also be buying at 7,900? In fact, 8,000 now.
Lata, let's put it this way. 2 weeks back when we did our topics, we increased the trading range for the market from 7,800 to 8,800 to what we did was to 8,000 to 9,000 levels. That's the trading range we thought for the next quarter or so. But in a couple of days, in exactly less than a week, all hell has broken loose right now. The markets have just went the other way. The fundamentals of the kind of a psyche that is there, a confidence level globally has reversed. So we have seen a sudden lack of confidence across the markets. It's not only in India, it's a contagion effect, as I would call it. So our thoughts still remains fundamentally things need to improve. What is happening globally, how much of more pain globally people have to take. And I would think that if you're going to see, because of this pain, if you're going to see a large FII selling, I would suspect that ETFs would have already started seeing redemptions. And if that happens, probably you have to wait and watch. And if you do, you definitely need to put in some part of the money in, probably around 20% at least, to put the money in, because I don't know what kind of what levels these markets can go down if an avalanche of selling comes in, etc. And that's purely from a global point.
And where would you put it in? Would it be in IT pharma because of the way the rupee has gone, or would it be like Sanjay says, even in cyclicals like banks?
See, let's put it up this way. It was our estimate that probably before the quarterly results happened, IT was probably underweight in many portfolios. So you've actually seen investment going into IT in the last month and a half, and probably a lot of funds have actually gone back into a neutral stance, or even to some extent on an overweight stance. Pharma too, there has been disappointments in the pharma sector per se from companies like Lupin, Cipla, etc., where we have seen these stocks give away a lot of the gains that it had had. And so you're actually seeing those things happening around. And banks, I think the Indra news has taken up a lot of these public sector banks will just sharply run up. And I would think that banks will be the place where even when things starts to change, you will see first investments coming into the banks yet again. So if the banks corrects, I think I'll use it as an opportunity to invest again in the banks.
Sanjay, what is the risk of this market going through a period similar to what it did in 2008? And sometimes, these things have the habit of repeating themselves in a 7-year cycle. Of course, that's painting an extremely bearish position. But what is the risk for that?
Forgetting all the, just absolutely subjective, objective, and hyperbole statements that we all make and get into the panic mode, including me at times, and start, totally get so emotional about prices and emotional about the market. But if you look at completely realistically and objectively with key data points and key variables that you have at this point of time, let's begin with the first one. What I think we have in our favor, and specifically in India's favor at this point of time, is the fact that commodity prices are at multi-year lows. We are a commodity consuming country. We are a country with phenomenal domestic demand. At that point of time, if you recollect, we were living with oil and all other commodity prices at very high levels. We were looking at fiscal and current account deficits at extremely high levels. At this point of time, it's the other way around. We are one of the fortunate countries who's actually benefiting from that. Yes, we do have some amount of issues related to currency, but I clearly believe that's by design. That's by design by the government and Reserve Bank of India, because it helps us both in terms of export competitiveness as well as the conscious design of the Make in India program. So that's the reason why you're seeing the government and the RBI not aggressively supporting the rupee at the levels that one, as common wisdom, wants it to. So therefore, I think that's a key differentiator between 2008, 2009. Plus the fact that, retail at this point of time overall isn't as leveraged or isn't as involved and totally consumed by the markets, financial markets. So therefore, massive unwinding that we had at that point of time will not happen, what we saw then. Then I think the key issue is a more decisive and a clear government with a much better mandate here in India. So, even if the world collapses and everything goes wrong with the rest of the world, India would still grow at a extremely, extremely negative and a conservative outlook of 4 to 5%. Forget everything else. Our own inertia and momentum will ensure we grow at that level. And so, therefore, in that kind of situation, I don't see we kind of being, a victim or being kind of sucked into that kind of a 2008, 2009 position that India had to face, and we had the massive slowdown a few years ahead. So a combination of political factors, commodity prices, and a lot of the other factors, interest rate cycle being in our favor, will ensure that we do not kind of get into that prolonged phase of 2008, 2009.
Well, I completely take your point, and more strengths to you, Sanjay, Anuj, it is very unfair to even get 2008 comparisons here. I distinctly remember towards end 2008 and early 2009, people were talking about depression, not deflation. I mean, it was looking like a long repeat of the Great Depression. We are nowhere near that. The US GDP numbers are coming out next week, and in all probability, they're going to be a 3 point something. Much better than the provisional numbers, which were a 2 point something. As well, what have we counted down in China? It's probably going down from probably 7.2 to 6.8 or thereabouts. And there's no point saying, I don't believe those numbers. You should not have believed 13% also in that case. So, I mean, depression, to paint the same scenario as 2008 is going too far.
Lata,
I would think that...
Yeah. We are saying that with the benefit of hindsight now, about 2008, right? Who knows, in 2017 we might say the same thing about 2015. At the end of the day, it's global financial markets. Nothing is to be taken for granted. No, I am not saying something like this will happen.
No, I'm only saying that you have to go with what factors you have.
Exactly.
No, certainly, I mean, the benefit of hindsight can make anything look wrong.
Exactly.
But if you look at the raw material in terms of numbers that we have, to compare this to anything like the post-GFC, the October to March, the kind of thought processes we went through for the global economy, I don't think we are anywhere in that picture. We are certainly slowing. We certainly probably overestimated because there was so much liquidity. The markets gave us the feeling that things are better than they probably are. But I would still think that we are nowhere near depression economics. So the point is now we are distinguishing whether the global financial markets are only going to take the incremental Chinese number, fall, and then readjust at the lower level. As always, is it buying on dips that is going to benefit? Or whether this time the global financial markets are reassessing and saying that 7 years, the central bankers have printed notes and this economy has not improved. So I'm going to sell like no tomorrow and there is going to be a 10% correction. That is the debate really we are having. And which side of that debate will you be, Sanjay?
Lakaya, I just wanted to say a very good point that you made, and which I missed out when I was totally focused on India and the 2008-9 comparison that Anuj brought up, was the fact that U.S. is coming out of its problem and U.S. has started to grow. U.S. is in a positive situation right now, and in fact, there is a clear message, a clear talk about interest rates going up in U.S. and not easing that what happened in 2008 to support the world markets as well as, of course, solve the problems of the U.S. financial system. Now, probably the rate increases may not happen or may get delayed. So that's a very important, ingredient to the mix at this sort of time if you want to analyze 2008 versus what we are today, and can anything like that be happened, or, can anything like that is starting to play out. So that U.S. equation is extremely important. So my answer to everything here is that, yes, India is not isolated. We will have pain if there's more pain in the global markets, but we are better off to handle it compared to what we were in 2008, 2009. Primarily because of the factors that I've brought to the fore at this point of time in terms of commodity prices, political stability, the situation that's there in the world right now. So a mix of this, I think. So I would prefer be on the debate that, is this a good time to start deploying money? Yes. Now the question is whether you're going to do it at 7,900 or 7,800 or 7,600. That's the question. But are you going to stay off the markets because you think a 2008 time is going to play out and next 5, 6, 7 years are going to be again a wash? Sure. No, I think I completely disagree with that. I'll prefer being on the wrong side, but I would prefer taking a call here and say, look, it's very clear that this is the time to look at companies which are going to benefit from the cycle, both domestic as well as international, because what U.S. stands right now and how central bankers are so aware at this point of time, and particularly at 2008 levels, they were not. They were also grappling with this animal, as to what really is happening. Where is this, bull in the China shop leading to? Sure. They couldn't really handle it that time, and they were kind of reacting to situations. But right now, they're much more proactive than reactive.
Okay, Sanjay. Point taken. So clearly, Sanjay more constructive on the market than he has been through the year, maintaining 7,900 as the bottom. Sanjay, thanks for your call today. Final word from Sreesankar as well. Sreesankar, in the mid-cap basket, anything that looks good, especially after today's fall?
See, again, not only on the mid-cap basket, one significant change for us is when we look at the inflation expectations, that has come down quite dramatically. The commodity prices are down, the crude prices again, which was not expected to be at 40. If it's in the near term or probably for the next 1 year, etc., going to remain extremely low. I think the inflation expectations is going to come down. look at FMCG companies today. I think everyone is offering freebies in terms of the raw material prices remain low. There is a lot of discounts and offers going on. So we expect to see even a increasing volume coming from a lot of these FMCG companies. And I don't think that investors will be selling those companies in a hurry right now. So I think from a point of view, lower inflation expectations going forward, and that's going to change significantly the way we look at it. As I said earlier, our expectation was around 8,000. I think relatively it's all looking to be good for India. But when panic strikes, I don't know. Suddenly there is a lot of selling which keeps happening. That's what we are seeing today.
Fair point. Sentiment at the moment taking hold. But Sreesankar, thank you as well very much for joining us. The common theme we have got from both our guests is that they would of course be positively attuned towards the dollar stocks, IT and pharma. FMCG was another pick from Sreesankar, which would obviously benefit from lower inflation levels. But I think both of them are actually going in for cyclicals. Both of them said yes for banks at a particular point in time. So clearly, the market is not throwing in the towel. At least many of our experts are not. We have to take a break, but you have something for our viewers?
Indeed, our closing bell money control question of the day is also something similar to what we have asking our guests. Will you use today's dip to buy stocks? As